What if the most dangerous assumption of our time is one we're taught as children? The idea that if you work hard, save your money, and play by the rules, you will eventually own a home, a place that is yours, a foundation for your family, your future, your legacy. For generations, this was the deal. But for millions of people under the age of 45, that deal has been broken. They are generation rent, and they've been told a story about why this happened. A story about avocado toast, lazy participation trophies, and irresponsible spending. But what if that story is a lie? A convenient fiction designed to hide a much more uncomfortable truth? What if the dream of homeownership wasn't lost by a generation, but was taken from them? To understand how we got here, we have to go back to the era that defined the modern housing dream, the post-World War II boom. For the first time in history, homeownership became a mass phenomenon, accessible to the average factory worker, the teacher, the shopkeeper. This wasn't an accident. It was a meticulously constructed system. The GI Bill offered low-cost, zero-down payment mortgages to millions of returning soldiers. The Federal Housing Administration, FHA, insured loans, making banks feel safe to lend. And the government poured money into building the interstate highway system, opening up vast tracts of cheap land for sprawling suburbs. The formula was simple, and for the greatest generation and their children, the baby boomers, it worked. The home became more than a place to live. It was the primary vehicle for building wealth. It was a forced savings account. You paid your mortgage for 30 years, and at the end you owned an asset that, historically, only went up in value. But within this golden age, the seeds of a future crisis were being sown. Two fundamental shifts occurred that would, decades later, shatter the dream for their grandchildren. First, in the 1970s, the U.S. moved away from the gold standard and embraced fiat currency. This, coupled with the oil crisis, led to a period of stagflation, high inflation, and high unemployment. To combat this, the Federal Reserve, under Paul Volcker, cranked up interest rates to unprecedented levels. The Fed funds rate peaked at over 20% in the early 1980s. This successfully killed inflation, but it also made mortgages prohibitively expensive for a time. It was a shock to the system, teaching a generation of policymakers that the economy was a machine that could be fixed with aggressive interest rate manipulation. The stability of the post-war era was over. The second shift was more subtle, but even more profound: the rise of financialization. Starting in the 1980s, the economy began a fundamental transformation. We began to shift from an economy that made things to an economy that traded financial instruments. The goal was no longer just to produce goods and services, but to maximize shareholder value, to generate returns through complex financial products. For decades, housing was a stable, boring, local market, but a few powerful minds on Wall Street saw a different future. They saw a multi-trillion-dollar asset class, ripe for exploitation. They saw a mountain of American debt that could be bundled, sliced, diced, and sold to investors around the world. And they built the machine to do it. The innovation was called the mortgage-backed security, or MBS. Here's how it was supposed to work. A local bank would issue a mortgage to a home buyer. In the old days, the bank would hold that loan for 30 years, collecting the payments, but that tied up their capital. With MBS, the bank could now sell that mortgage to a Wall Street investment firm. That firm would buy thousands of mortgages from all over the country, bundle them together into a single security, and then sell slices of this security, these bonds, to investors like pension funds, foreign governments, and insurance companies. The theory was simple. While one person in Cleveland might default on their mortgage, it was statistically impossible for thousands of people all across the country to default at the same time. The risk was diversified away. This system, it was argued, made credit cheaper and more available for everyone, and for a while, it did. This new financial engine was supercharged by political consensus. For decades, politicians from both sides of the aisle promoted homeownership as the ultimate civic virtue. It was a cornerstone of the American dream. Policies were enacted to encourage lending, often to communities that had been historically excluded. The Community Reinvestment Act, for instance, was designed to combat redlining, the discriminatory practice where banks would refuse loans in minority neighborhoods. Its intentions were noble, but in the new financialized landscape, its effects would be twisted. Then, in 2001, the dot-com bubble burst. The stock market crashed. To prevent a deep recession, the new Fed chairman, Alan Greenspan, did what the Fed always does in a crisis. He slashed interest rates. The Fed funds rate went from 6.5% down to 1%. This was financial rocket fuel. Suddenly money was almost free. Where did all that cheap money go? It didn't go into the battered stock market. It flooded into housing. We are now in the mid-2000s. The housing market is exploding. It's a national mania. Home prices are skyrocketing at a pace never seen before. The classic 30-year fixed mortgage seems boring, quaint. Why wait to buy a house you can't quite afford when there are new, innovative loan products? Introducing the interest-only loan, the Ninja loan, no income, no job, no assets, and the pièce de résistance, the adjustable rate mortgage, ARM, with a teaser rate of 2% that would reset to 8% or 9% after 2 years. These were the tools that allowed people to buy homes at prices that were completely detached from their actual incomes. And Wall Street's debt machine was hungry. It had an insatiable appetite for more mortgages to bundle into more mortgage-backed securities to sell to more investors. The incentives became perverse. The mortgage broker was incentivized to close as many loans as possible. His commission depended on it. The bank was incentivized to issue the loan. They weren't going to hold it anyway. The Wall Street firm was incentivized to buy the loan. Demand for MBS was global and insatiable. The rating agencies Moody's, Standard & Poor's were paid by the Wall Street firms to rate these securities, and they happily slapped A investment-grade ratings on bundles of what were, in reality, incredibly risky loans. The one person in this entire chain who was not incentivized to be careful was the home buyer. They were told they were being responsible, getting in on the boom. Don't worry, they were told, you can always refinance later. Prices only go up. The entire system was built on a single, fragile premise, that home prices would rise forever. And for a few glorious years, they did. The very act of this cheap credit flooding the market was itself driving prices higher, creating a self-fulfilling prophecy, a classic bubble. A whole generation of young people, millennials, were coming of age during this time. They were in high school, college, starting their first jobs. They looked at these insane prices and felt a first creeping sense of dread. But they were told, this is just how it is. Get in while you can. The dream was becoming a fever dream, but bubbles by their very nature pop. In 2006, home prices peaked. The pool of greater fools people, willing to pay an even higher price, dried up. The first dominoes began to fall. Those adjustable rate mortgages started to reset. Monthly payments for families doubled or tripled overnight. They couldn't pay. They defaulted. Foreclosures soared. But this wasn't the 1930s, where a local bank would take back a handful of properties. This was the age of financialization. Those foreclosures weren't just individual tragedies, they were cracks in the foundation of a global financial edifice. Remember those safe mortgage-backed securities? They were now filled with toxic, defaulting loans. Their value plummeted. The banks and investment firms that held them were suddenly staring into the abyss. They were over-leveraged, meaning they had borrowed enormous sums to buy these securities, and now they were facing catastrophic losses. In September 2008, the world witnessed the unthinkable. Lehman Brothers, a 158-year-old investment bank, collapsed. The global financial system froze. Credit markets seized up. The machine that had been built to pump endless credit into the economy stopped. The Great Recession had begun. Millions lost their jobs. Millions lost their homes. But the pain was not distributed equally. The architects of the crisis in Washington and on Wall Street were, for the most part, bailed out. The pain was offloaded onto the public. And for Generation Rent, the young millennials just entering the workforce, the crisis was a defining, catastrophic event. They graduated with tens of thousands of dollars in student debt into the worst job market in 80 years. Their first taste of the real world was economic trauma. The dream of homeownership didn't just seem distant, it evaporated. In the aftermath, the response was swift and unprecedented. Central banks around the world, including the Federal Reserve, launched a policy known as quantitative easing, or QE. In simple terms, the Fed created trillions of dollars and used it to buy up the toxic assets from the banks, stabilizing them. It also, once again, slashed interest rates to zero. The goal was to reflate the economy, to get banks lending again. And in one sense, it worked. It prevented a second Great Depression. The stock market began a historic bull run. Asset prices recovered, but there was a devastating, unintended consequence. This massive injection of cash didn't go to Main Street. It went to Wall Street. It flowed into financial assets, stocks, bonds, and crucially, back into real estate. But this time, it wasn't a bubble driven by subprime mortgages to everyday people. It was a bubble driven by institutional money. Wall Street had discovered a new business model. If you can't beat them, buy everything out from under them. Private equity firms and newly formed corporations went on a buying spree. They bought up hundreds of thousands of single-family homes, often with all-cash offers, far outbidding ordinary families. These homes were converted into rental properties. For the first time in American history, a significant portion of the housing stock was being systematically purchased and removed from the ownership market, creating a permanent landlord class and a permanent renter class. The game had changed. The goal was no longer to help people own homes, it was to extract rent from them. Forever. The fixes for the 2008 crisis did not restore the old system. They created a new, more divided one. The policies designed to save the economy from a collapse caused by a housing bubble ended up inflating a much larger, more insidious bubble in everything, and Generation Rent was left holding the bag. They were saddled with student debt, stagnant wages, and now a housing market that was more unaffordable than ever before, not because of a crazy free-for-all, but because of a cold corporate consolidation. Just as a generation was starting to recover, another shock, the COVID-19 pandemic. And once again, the response was to flood the system with money, trillions in stimulus. Interest rates were cut to zero again. What happened next was the final, brutal acceleration. With remote work, people needed more space. With record low rates, borrowing was cheaper than ever. A feeding frenzy ensued. Bidding wars became the norm. Prices increased by over 40% in just 2 years. The generation that was already locked out was now pushed to the absolute brink. And then the final twist of the knife. To combat the inflation caused by all this stimulus, the Fed began aggressively raising interest rates. So now, Generation Rent faces the worst of all possible worlds. Astronomically high house prices, combined with mortgage rates that have doubled or tripled. The monthly payment on a median-priced home is now higher than at any point during the 2006 bubble peak. The dream isn't just deferred. For many, it is mathematically impossible. In 1980, the median home price was 3 to 4x the median income. Today, it's over 7x. The share of homes bought by first-time buyers is near a 40-year low. Institutional investors bought a record 1 in 4 single-family homes, sold in some Sunbelt markets in 2022. The average millennial has a net worth 20% lower than their parents did at the same age, despite being better educated. The patterns are repeating, but on a higher, more dangerous plane. The system is not broken. It is working exactly as designed for a small group of asset owners. For everyone else, it is a machine for transferring wealth from the young to the old, from the future to the past. So, where does this leave us? The story of Generation Rent is not a simple tale of bad luck or individual failure. It is a cause and effect story of financial engineering, political choices, and systemic failure. If we are to have any hope of changing it, we must first understand it. Here are 3 clear takeaways. Takeaway 1. The game is rigged, but not in the way you think. It's not about avocado toast. It's about the fundamental structure of our economy. We have moved from a productive economy to a financialized one, where the primary goal is to inflate asset prices. Housing is no longer treated as a human need, a place to live and build a life. It is treated as a financial asset, a vehicle for storing and growing wealth. When you view a basic necessity through that lens, it's inevitable that it will become unaffordable for the many to enrich the few. Takeaway 2. The fixes often make the problem worse. The policy responses to crises, slashing interest rates, quantitative easing are designed to stabilize the system in the short term, but their long-term effect has been to exacerbate inequality and inflate asset bubbles to ever greater heights. We are now in a doom loop where the cure for the last crisis plants the seeds for the next, even larger one. We are kicking a can that is getting heavier and more dangerous with every kick. Takeaway 3. Generation Rent is the canary in the coal mine. The housing crisis is not an isolated issue. It is the most visible symptom of a deeper societal fracture. When an entire generation is systematically blocked from the primary means of building wealth and stability, the consequences are profound. It leads to delayed families, lower birth rates, diminished entrepreneurship, increased political polarization, and a deep-seated generational cynicism. The collapse of the housing dream threatens the very social contract. Here is the open-ended thought, the warning. We are at a crossroads. One path leads to a neo-feudal future, where a small propertied class owns all the assets and a much larger class rents everything, their homes, their cars, their subscriptions, forever, never building equity, never achieving security. The other path requires a radical reimagining. It forces us to ask uncomfortable questions. Is eternal home price growth sustainable or even desirable? Do we need massive tax reforms to disincentivize treating homes as speculative assets? Should we build millions of new units of housing, including social housing? Do we need to fundamentally break the power of institutional investors in the single-family home market? There are no easy answers, but the first step is to reject the lazy narrative that this is the fault of a generation that bought too many lattes. It is not. It is the result of a half-century of economic choices that prioritize financial wealth over human well-being. So what is the call to action? It is not to give up. It is to get informed, to understand the mechanics of the system that shapes your life. Your assignment is this. 1. Talk about it. Have these conversations with your friends, your family. Break the stigma and shame. The problem is not you. 2. Look local. The most potent changes often happen at the local level. Attend city council meetings. Support zoning reforms that allow for more housing duplexes, townhomes, apartment buildings. Fight NIMBYism, not in my backyardism, that prevents new construction. 3. Demand a broader conversation. When politicians talk about the economy, ask them about financialization. Ask them about corporate ownership of homes. Ask them about building an economy where work and thrift are rewarded with stability, not perpetual rent. The dream doesn't have to die, but it cannot be the dream of the 1950s. We have to build a new one, grounded in the reality of the 21st century. An economy that works for the many, not just the propertied few. The story of Generation Rent is still being written. What happens next is up to us,